Welcome back. You made it through the first video and that one is pretty long, so very nice. At this point, you're already ahead of most people because what most people want is a green means buy, red means sell indicator, and those don't exist. And you just spend a whole bunch of time actually learning how the market really works. Now, I am assuming that you watched that first video because if you didn't, none of what's in this video is going to make sense to you because I went over BigShort's UI, I went over some fundamental indicators and some setups that you can start using almost right away. Without that video, this video is not going to make sense, so go back and watch it if you haven't already. Now, remember those kind of three forces from the BigShort advantage from video one, right? Positioning, hedging, and manipulation. Now, that first video was mostly all about participant positioning in the market and flow. And this video is these other two parts because there are participants on pretty much every other side of the trade you take or other people trade that are pretty much forced to trade in certain situations. And when you understand what they're forced to do, you can read the market on a level that most people and most retail traders especially have no idea even exists. So in this video, we're going to go over the interaction between BigShort indicators and price, go over GEX, go over charm exposure, and go over some other more advanced indicators and some that I use almost every single day. So let's get into it. First, let's talk about GEX or Gamma. But before we get into how to trade this, let's talk about what Gamma actually is and how it works. This is going to be quick, I promise you. Now, this is going to be a simplified example. This isn't, an advanced course, but the first question I have for you, what moves what, right? Does the stock move the option or does the option move the stock? Obviously, it's the first one, right? As the stock reprices, the option reprices, barring any weird Greek shenanigans that can happen that we're just going to ignore for a second. But the second one, this one, also happens, and on some days and sometimes it's even more important than this more obvious one. So let's go over a quick simplified example. Let's pretend this is you and you decide to buy a call, but you're not buying a call from Bob. I mean, of course not. You're buying a call from the market maker. So the market maker sells you that call. You now have a very nice call. Congratulations. But there is a problem, right? Because if the stock goes up, the value of the call also goes up. But the market maker, they are short a call now, right? So if the value of this call that you buy goes up, the market makers will be in the red for that exact amount and exposed to potentially unlimited risk. And to avoid that directional risk, they have to hedge. And to do that, they're going to look at the delta of the call that they sold you. So if that delta of the call is, let's say, 0.3, what they're going to do to stay delta neutral is they're going to buy 30 shares of that stock. So theoretically, if the value of the call you bought goes up, that value is exactly how much the market makers would lose at that point. But because they are hedged with these shares, the shares would go up and it would be delta neutral. They wouldn't really gain or lose any money. But the problem with delta is that it changes. So as the value of the underlying goes up, the value of the call goes up, and the delta actually goes up as well. So now the delta might be 0.4. So what do the market makers have to do? They have to buy 10 more shares of stock. So now they have 40 shares in total and they're all fine and dandy. Now, this process here is called delta hedging, and all Gamma is just a measure of how fast these market makers have to hedge. But what happens if we multiply this process by thousands of people? So let's say the price goes up a little bit. Obviously you bought the call, the market makers hedge, cool. But then let's say there's more people like you and more people like you and more people like you. Well, they come in, they buy a bunch of calls, market makers have to hedge, so the price might go up a little bit more. But that price going up actually attracts more and more and more and more and more and more people, making the price go up again. All of those dealers and market makers are forced to hedge against all of these calls. So they have to buy shares, which can actually force the price to move up, creating this kind of almost a self-perpetuating scenario. Now, obviously, this isn't the only thing that moves price, and for certain tickers, it's more powerful than others. But if you trade SPY or any ticker that has 0DT options, this can be a very, very powerful force during the day. Now, one reason this matters to you trading is if sometimes you feel like SPY is a freaking volatile madman that's going crazy, and there's no real big news or anything, it might actually be because we are in a negative gamma environment. And all negative gamma means is that dealers have to hedge in the same direction of the move. So if we go up, they have to buy shares to hedge, which can cause another up move. And if we go down, they have to sell shares to hedge, which can actually make those down moves stronger. And when we are in a positive gamma environment, they do the opposite. They have to buy the dips and sell the rips, which is why price is a little bit smoother and doesn't always go as crazy. Now, this doesn't mean that every single negative gamma day is going to be insane and every positive gamma day is going to be a range day or a very peaceful day, but it's something you should be aware of, especially if you trade SPY, because sometimes it might be a good idea to downsize on really negative GEX days, or maybe that's your bread and butter, in which case, go crazy. Now, this applies both to aggregate gamma throughout the day, which you can see is this golden line in the skew panel, and also to the gamma breakdown by strike. For example, if you only see red here, like all of this was red, you should expect more volatile moves because these green bars can function almost as these little barriers that price bounces off because dealers have to hedge in the other direction. Without those green bars, there could be very, very big swings between bounces. And gamma has its own levels as well, some of which I introduced in the previous video. But if you go to settings and you scroll down here to price levels, all of these are based on gamma. So we're going to go through these. Gamma gravity, which is represented by this line right here, is the strike where dealer exposure is most concentrated and they're going to have to do a lot of dealer hedging. So price can sometimes pin around this level and it can also act as support. Gamma flip, which is represented by this line right here, is where dealer exposure crosses that zero line where you go from positive to negative gamma. And this is basically the border between those two positive negative gamma universes I just talked about. Now, I already went over the call wall and the put wall in the previous video, so here's a quick refresher. The call wall is this green line, the put wall is this red line, and generally the way you want to look at it if you're trading simply is green up means bullish, green down is bearish, red down right here generally is bullish, and then red up tends to be bearish. And this only applies when the green line is above the red line. When they cross, all bets are off. But you might be wondering, why can this be bullish or bearish? What does that even mean? Now, there are a couple of theories on this, and if you don't care about theory, you can skip this part. It's going to be quick. Generally, when the call wall moves up, there is a high level of new call buying or call open interest around that level. It could just be a really big institutional buy, which could move the call wall. It could be a lot of retail buying. Whatever it is, dealers will have to hedge against those calls, which can lead to some buying pressure. Plus, if you remember, that call wall generally acts as resistance. Lifting that resistance can allow price to move higher without dealers hedging against it. And when the put wall moves down, it could be kind of the opposite, where puts at this strike got sold or rolled, so dealers can buy back the short stock hedge they had against those puts, which acts basically as mechanical buying. Now, these are just theories, don't read too much into them, just focus on the direction of where these walls are moving. Next up, we have my MVP, the MVC, or the most valuable contract, which is represented by these yellow diamonds right here. Generally, the naive MVC is just the strike with the highest gamma, but here at BigShort, we don't care about what is generally correct, we care about what is more predictive. So our MVC has a little bit of BigShort spice added to it, which seems to make it more predictive. So for BigShort, it's not just the highest gamma, but the strike carrying the most hedging significance. And price can react differently to this MVC area depending on where that MVC is compared to price. It can act kind of like a magnet that is pulling price forward, as we see here, and then it can act as support or almost a wall that price keeps rejecting off of. So here we have move down, MVC moves up, we have it moving up, and then MVC moves down and we see more moving down. And here's another really quick example. We see that price is going down here, but the MVC is staying steady. So eventually we do hit that MVC, kind of bounce around for a little bit, MVC goes up, and then we usually do hit that MVC and kind of bounce around it and flounder for a little bit there. Now, one thing to keep in mind is that all of these gamma levels change constantly throughout the day, right? You can see the MVC is moving, call wall is moving, everything is moving. And if you scroll through the chart here, you will actually see gamma and charm, these right here, changing as I scroll through it. So you have historical data for that as well if you want to check that out. Now it is time for sex, and get your mind out of the gutter. I obviously mean charm exposure or charm by strike. Now, while gamma, which we have right here, measures how much delta changes based on the move in the underlying, charm measures how much delta changes based on time passing. But what the heck does delta changing with time even mean? So remember how the dealers hedge, right? They hedge based off the delta. So if an option has a 0.4 delta, they hold 40 shares. But delta, especially delta for 0 DTE calls, doesn't sit still. So for example, let's say some poor schmuck decided to buy a call for 746 0 DTE for whatever reason. That is an out of the money option, which means that with every passing minute, the odds of hitting that strike when we're sitting, let's say right here, is lower and lower, which means that delta goes down even price stays the same. So for example, if right here the delta was, let's just say 0.2, even though the price kind of stayed the same all the way around here, the delta as we approach the close, as the price stays the same, is going to approach zero because the odds of hitting that strike are basically at zero at that point. And if the option is actually in the money, the delta behaves the opposite way. So for example, if here for whatever reason delta was 0.8, because it is in the money, as we get closer to here, that option behaves more and more like the stock, so the delta approaches 1. So if the dealer is short that 747 call, right, they sold a call to some poor schmuck who's never going to get his money ever. Because it's an out of the money call, the delta right here goes from 0.4 to 0. And as the delta changes, and we talked about this before, the dealers can actually sell some of their shares. So if the dealers had 40 shares here, eventually here at this point, they don't need any of those shares, so they have to sell 40 shares to get back to 0. That is the mechanical charm pressure. Now let's go over Tay's simplified way of reading this, because I know all that gamma stuff can be complicated and really you don't necessarily need to know it, but sometimes understanding it, or at least understanding why these mechanics happen in the market, can help you understand how it can be an effective way to trade. On the Charm by Strike card, you can think of these green bars as 0 DTE calls and these red bars and these red bars as 0 DTE puts. It does include farther out expiries too, but generally Charm is strongest the closer you are to expiration, so you can think of it as 0 DTE calls. Once again, this isn't Harvard. We're just trying to get you to the point of being able to use Charm and this platform. So green means retail bought calls at that strike and dealers are short those calls. So they have a strong incentive to try to keep price suppressed and away from areas of high charm. And then obviously red is the puts. People bought puts and dealers are short puts. And as the price gets to that level, the dealers are more at risk of losing on the sold puts, so they're more incentivized to buy, creating bullish pressure. Now, of course, that's all great, but how do you actually use this? So I'm going to go through this day and pay attention to these strikes right here and watch how charm changes throughout the day. So at the beginning of the day, you can see that there was green charm around 745 to 747. And as we go on, that charm actually grows and grows and grows and grows. And now we have a whole bunch of charm at 746 and 745 at the end of the day. And obviously that ends up being the battleground that never gets broken through. And the simplest way of trading using this is just by looking at where green and red is compared to where spot or the current price is. Generally, if you have green above and red below, like here, price can get pinned because there's resistance going in both directions, which actually is pretty much what happened here. Now, if you have the reverse of that and we have a whole bunch of red above and a whole bunch of green below, that means that no matter which direction we move in, that move could slice like knife through butter and we could go strong in one direction or the other direction, but we don't necessarily know which direction. We just know that move might be magnified due to dealer hedging. If all of this is green, that is pretty bearish. And if all of this is red, that is pretty bullish. And if there's no charm around spot, so let's say we were kind of around here and there was almost no charm or kind of like this, that just basically means there's nothing really going on there, at least in relation to dealer hedging relating to charm. Now, one word of warning, don't think of a gap in charm as a gap to be filled. That's not how it works. It just means that there's nothing happening there and you can ignore it. Next up, we have this pane right here, which is skew. Now, skew is basically just the difference between implied volatility for calls versus puts, or in plain English, how much more expensive downside protection is versus upside puts. Now, the blue line here, as you can see right here, that is traditional academic skew. It's been well studied. There's a lot of studies showing that it works. Now, you might notice here that SPY seems to generally have a negative skew, and you would be correct because that means that out of the money puts are more expensive than out of the money calls. Now, why is that? Well, it's because most people are willing to pay more for downside protection than take an upside risk. Very simple. But of course, a big short, we're not going to stop there because that's kind of boring. And we also have fast market maker skew and slow market maker skew as well, which is represented by these light purple and dark purple bars in this tab. Now, how do you read these? Generally, and this applies to SPY and seems to be unique for each ticker, generally when we look at SPY, we look at fast market maker skew as inverse. So these bright skews generally inverse. And then the dark skews, the slow market maker skews, we look at them generally as directional, but taking a little bit longer to actually start seeing an effect from them. So this right here, I actually circle a perfect example. Right on this bar here, we have a combination of skews. We have a dark skew up, and then we have this fast market maker skew, bright skew down, which eventually kind of leads to this upwards move. And generally these brighter skews don't seem to have a super long effect, but they can be useful for actually catching some small reversals here and there. So if we take a look at this one, for example, this one was just a bit of a negative bar and a small reversal here. And of course, they do come in all different shapes and sizes. So if we scroll down here, we will see that we had this really big bright skew here and a really big dark skew here, and we get this really big bar after hours. Now let's talk about manipulation. As you can see, I turn it on, and that is this pane right here. Now, once again, generally, we do not use manipulation. We pretty much only use it during very fast moving events like FOMC or sometimes earnings, but this day was actually FOMC. So a lot of big short traders actually use this manipulation to trade. Now, once again, if you're a beginner, Do not use this to trade, but I know you're probably going to be curious about it. You're going to ask questions, which is why I wanted to go over it here. But take your time and focus on other indicators first, because if you get it wrong, it can cost you a lot of money. And we want you to make money. We don't want you to lose money because of Big Short. That's pretty much the exact opposite of why we exist. So please, please listen to me. Don't start off with using manipulation. Now, generally manipulation is an inverse indicator. For example, this bar right here, that was when the data was actually released. So we have a downwards bar pointing to a potential upwards move. And this bar was actually formed before the move happened. So I was actually able to trade this. I got filled about halfway through the candle and I exited around here. So that was a nice quick little move. Then there's kind of a whole bunch of nothing as we're waiting for Warsh to speak. And as you start speaking, we start seeing this negative manipulation here leading to this price move up. But then what is that, right? We see that the manipulation actually flipped and now it is positive. And would you look at that? We actually had a big downwards move down with all of this big positive manipulation. So those are the main indicators you will be looking at. And now it's time for one big question. How quickly does price react to these different Big Short indicators? We get this all of the time. And unfortunately, the answer is it depends. But what does it depend on? And it depends on churn and size of flow. But what do I mean by that? Well, let's take a look at this Ferris wheel and use this as an example. People are getting on and off all day. And sometimes this Ferris wheel is spinning very, 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 very fast. And sometimes this Ferris wheel is spinning very, very slow, allowing people to enjoy the view. And sometimes also there's a whole bunch of people coming into the Ferris wheel because they want to ride it, because they heard how great it is. And other times there's not really a line. There's just only a few people who are on the Ferris wheel. They're enjoying the view as the Ferris wheel spins very, very, very slowly, allowing them to take in the beauty of this mystical, magical world that is Big Short. So churn is how fast this Ferris wheel is moving, and flow is how many people, or how many animals in this case, are getting on and off the Ferris wheel. For example, if you're trading SPY sometime in the morning, the Ferris wheel is spinning fast, people are coming in and out, there is a lot of churn, there is a lot of flow, and generally Big Short indicators can work same bar or next bar. They work relatively quickly because there's a lot of churn and a lot of flow. But as we approach that kind of midday lunch hour time, all the people and all the animals, they're going off to lunch, they don't really care. All the retail is out, they're busy at their jobs, and there's not really a lot happening. So in that case, I get this question a lot. Big Short indicators can take a little bit longer to work. There's almost this time dilation effect where people ask me like, well, isn't this a bullish sign or a bullish indicator? It's like, yeah, that is bullish, but also there's like no flow. So it might take a couple of bars for it to actually work. You might actually have to have a couple of bars that go in the same direction for flow to be big enough and for churn to be big enough to have any sort of effect on price. And of course, if you look at power hour can get crazy. There's going to be a lot of flow, a lot of churn, and generally, hopefully you'll get this by now. This is like my 5th time saying it. Don't trade power hour, especially if you are starting out. That is going to be bad news bears for you, so just don't do it. Finally, each ticker has its own churn. So something that takes, let's say, 5 minutes to play out on SPY might take 20 minutes to play out on Tesla and might take even longer on a small cap stock because there's just not a lot going on. This is why we do recommend, if you're going to trade other tickers, to go through the historical data, right? Go through the historical data, go through the previous days, to see how churn and flow works and how price actually reacts to Big Short indicators, because each ticker does have its own kind of flow and churn that you should be aware of. And the reason I'm telling you about this now is because number one, it's kind of a more advanced concept. And number two, it's the last thing you need to know before we get into the next section about how Big Short indicators and price actually interact and how you should be looking at both of those to make your trading decisions. All right, interaction between price and indicators. Now, this can take a while to actually put into practice, so don't worry if you don't start using it immediately, but this is something you should be aware of, and you can always come back to this video or just make note of this yourself as you look at price action and as you trade. So the basic idea in one sentence is almost kind of like that Momo exhaustion thing in a way, because it's not just about how much or how far price moved, but it's about how much effort it took to move it that far. So as an example, let's take a look at just this bar right here, right? And I'm going to draw a line so you can take a look at the right Momo bars and right smart flow. So as you can see, this is a pretty significant bar. This bar is almost a $2 move in SPY. That's a pretty big move in one bar. But as you can see here, Momo flow on this bar was pretty small. If I hover over it, you will see that Momo was about 10 million, which if we look at the percentiles, you can barely see that thing. It's basically not even noticeable. And if you look at fast flow, it's also kind of not noticeable. So in this case, it took about 10 million of Momo to move price up this much, $2. Interesting. And now let's take a look at this bar right here. On this bar, we had a Momo of 125 million. That is basically 10 times more than the previous Momo bar. But as you can see, we were in a bit of an uptrend, and all this big Momo bar did is it created this little wick, and that's all it could do, because in reality, this is a very, very, very small move in SPY. Or let's take a look at Micron, not a SPY ticker, right? So here at the beginning of day, let's take a look at these 4 bars specifically. As you can see, we had a little bit of Momo down, tiny bits of Momo up, and that really didn't move the price that much. But then right here, what do we see? We see a pretty significant Momo bar, at least for this day, right? This is 40 million, which is pretty much 8 times more than the previous Momo bars here. And as you can see, this much Momo and this much fast flow only move the price pretty much as each of these bar combinations right here. So there's a lot of effort being spent to move the price up, but price really isn't budging that much. And what happens after? Well, the path of least resistance ends up being down. Now, if we break this down, there's basically 16 combinations that you can have, right? We can have a small buy, small sell, big sell, or a small move up, small move down, big move down, and all of these are combinations. Now, if they're matching, so a small buy is a small move up, a big buy is a big move up, all of these, they're great. That's kind of common sense. Like, okay, we got a lot of buying and we moved up a lot. Okay, I guess that makes sense. What's more interesting is what I marked as green and as red, because this one is very, very obviously bullish and this one is very, very obviously bearish. If we're in this green rectangle, right, there's a small buy and a big move up. It means there's not really a lot of effort that had to be expanded to make that big move. There was no one sitting on the offer to absorb it. There was no supply at the ask. And it's possible that market makers even kept raising the ask because they're like, nah, that's fine. Let's let them get that big price move. We want it to go up. That means the up is more likely to be the direction of least resistance, so price can continue going up barring any other changes. And vice versa, if there's a small sell and a big move down, right, we're in this quadrant right here, that means that there's nothing on the bid to catch it, and most likely down is the path of least resistance. And if there's big selling and we are, for example, right here, and price maybe doesn't move much, or we get a small or a big move up, that's also really weird, right? That means that not only is someone gobbling up all of these shares, but market makers could even be raising the bid into people selling to push the price upwards. Really, really strange, something to watch out for. Now, the reason I only have these two marked as obviously bullish or obviously bearish is because that's generally how it works. All of the other ones that are kind of like orange or yellow, that's something to pay attention to. But if you're starting out, I would not trade on that because it can be easy to get into trouble. But it's something to keep an eye out on what happens when there's big selling, maybe price stays the same or even moves up. What happens when there's big buying and price stays the same or even moves down. And how does that affect price later on? Once again, this can vary ticker by ticker. This can vary based on churn and time and amount of flow. So this is something you're gonna have to explore, take a look at, and just keep this in the back of your mind as you trade. This isn't something that you need to focus on or pick up immediately. All right, so with all of that out of the way, let's do something that you should definitely do on your own, but I wanna give you a couple of examples on how I do this and how you can think about going about this. And that is actually trying to predict what's going to happen next based on the indicators going bar by bar. This way it simulates real world trading a lot better because you're going bar by bar and think, okay, what would I do here? Would I buy? Would I sell? Or more importantly, is there no trade here and I should just sit this one out, chill, and maybe go even on a little walk or take a little nap, because sometimes the best trade is no trade at all. And depending on when you're watching this, all of the BigShort indicators will be added to Chart Game, so you can actually practice on your own time. Chart Game is completely free, and that way you can actually learn how to manage your bankroll, or how to manage your emotions, and of course practice and learn BigShort indicators. Now it depends on when you watch this, so check out the Chart Game link in the description so you can test it out and play a little bit of BigShort and test out your skills. Now, even if you do watch this before we've added these indicators to Chart Game, we still recommend you to play Chart Game Swing Trader at least to number 1, see how you work on bankroll management, number 2, see how your psychology is, and number 3, prove to yourself that you can get to at least $1 billion and that you understand price action. Because if you can't commit yourself to get to $1 billion on Chart Game, and that's pretty much the easiest thing a a trader can do. And if you're a new trader, I definitely recommend chart game. And if you're an experienced trader, then chart game can just be a proof of your skills. Like, okay, yeah, I understand this. I have enough patience to do this. I have enough patience to play chart game and get to a billion. Tay can do it in about 2 to 4 hours, depending on what charts he can get. And pretty much every trader inside of BigShort who was really excited about playing chart game and wanted to prove that they can do it did become a great trader afterwards, or was even a pretty good trader before, but it helped them improve their risk management and just overall trading. So with that out of the way, here's how I approach BigShort practice and learning these indicators. Now, you know most of these indicators. You might have to go to the help center to get a repeat, rewatch this video, that's fine. But basically, I just open up a random date, and then what I do is I'm actually gonna move this a little bit over, and I'm just gonna go bar by bar and see what we notice. So let's take a look and see what we see here first before moving on. And you can pause this video if you want to. I'm just gonna go through and see what and tell you what I see. So first, let me actually take a look at gamma and charm. It does look like there's some bearish charm right around 750 that is growing, so that's interesting. And I do see some bearish charm around 746. So we could hit 746 potentially here, at least based on where the red charm is and the green charm is. We do seem to be, if we look at here, if we look at this gamma level here, let me just highlight, gamma, it went from positive to negative. We do have net options flow that at first went up a little bit, now it is coming down. We do have this kind of really big Momo and fast flow bar, or at least it seems big. Let's take a look at the percentiles. Not too big based on percentiles. And I do see that Momo here, let me move this out of the way. I see that the MVC dropped, and I see that Momo here is mostly buying. So all of these have been enough for Momo to get almost to the 0 point right here. And price action in general is moving down. So that's what I see. So let's expand and see what the next candle is. All right, so this next candle, we are continuing. Momo is still buying. NOF is still negative. And then fast flow looks kind of non-existent at this point. Okay, so let's move on a little bit more. I'm gonna go a couple bars down. So in here, you actually see, I believe, that the call wall is dropping. So that is bearish. Momo is still buying, which is interesting. NOF is kind of flat. And then fast flow switched to buying. Okay, another interesting tidbit. Let's go again. I also see, I didn't see this here because it wasn't expanded, that the MVC has dropped. Let me actually expand this a little bit more so I can see the MVC. But the MVC dropped right here as the call wall dropped as well, so that is bearish. All right, so I expanded a little bit more. We've hit the MVC, and there's one lonely dark pool above here. Just one dark pool doesn't really mean too much necessarily. Could be a little bit bearish. I mean, Momo is still buying, and Momo was buying this entire time as price went down. So price is going down. Momo has been buying. NOF has been negative. We're in a negative gamma environment, but we just hit MVC. So because we hit MVC, I would say that we could bounce off of here. Generally, I would not take a trade here myself. So let's see what actually happens. Let's expand a little bit more. So what we actually see here, and I know I expanded a little bit past just one bar, but let's take a look. So Momo is buying. It switched to selling for a little bit. NOF is kind of flat at this point. And then Momo is still buying, but we seem to be kind of almost consolidating or just standing around this area of a potential 1 hour breakdown. As you can see here, we did also break down on the 15 and on the 30-minute orb. Okay, that's interesting. Let's keep going. So I go further, I go further, I go further. All right, so now Momo is selling a little bit more, and Momo's flipped to selling right around here and right around here, which is interesting. NOF is still somewhat negative, but we still haven't really gotten too many moves down here. All right, let's expand it to this point. So MVC actually moved up and then moved up again. The call wall moved up, which is interesting. As you can see here, the call wall moved up, and Momo is still selling. So as you can see, there was a bit of this move downwards with Momo. Interesting. So on the way down, Momo was buying, and now Momo is selling with all of these, with MVC moving up, the call wall moving up. I would have loved to see a confirmation of NOF here. I don't see that right now, but I do see some dark skews popping up. Actually, they've been around for quite a bit here, which is interesting. So let's see what happens next. All right, MVC is still up here, but call wall moved down. So So a little bit scary. Momo is still selling though, and we do actually get a little bit of sold puts, which is a little bit bullish, but as you can see, that's not a huge move. Okay, let's keep going. All right, 2 more candles. We do see actually some positive price action here. Cool. So Momo has been selling, which could be potentially bullish based on what we saw here and here. The MVC did move up again right here, and price action is kind of confirming the move. So at this point here, potentially, I would have taken a trade either right around here or maybe even, that's kind of interesting. Looks like there's a bar missing here because you can't end the bar here and actually have the open here. It looks like there might be a piece of data missing here. But generally, I would consider taking a long either here or on this missing bar, which I assume probably was a positive bar that went like this. So let's take a look. If we keep going, as you can see here, okay, Momo is still selling. MVC is still up. And then right here, MVC moves down. We touch it. Momo flips. Here, I would potentially consider taking at least partials or even fully exiting. We do get a little bit of calls by on this bar, but this is a little bit potentially scary. So depending on your trading style, I would take partials here and then leave a runner, and then I would have a mental stop right around probably this level here or the low of a little bit below these candles. So let's see what happens. Okay, no, we can just keep going up. That's fine. I'm happy with that. And then let me just open up the rest of the day because I think you get the point. And then generally right here, right, as we're hitting MVC, as we're breaking past it with this bearish NOF, I potentially might have exited there, but we do have a really big call here. So maybe I would have stayed in. And then right here, we have some more puts. So NOF starts turning down. This stays flat. And the reason this stays flat is I'm willing to bet there's a charm. Yeah, look at that. There's charm at 748. That it's not huge, but there's green charm there. And then as we move down here, we actually start getting some DPs above. We have some green charm at 748. So there is that potential for a downwards move. Now, I wouldn't necessarily always take this trade just based off dark pools and charm, to each their own. But with MVC kind of sticking around here for a while and this call while dropping, there is a potential short opportunity somewhere around here once you start seeing these dark pools. Now, I would not have expected, just based off of what I'm seeing here, for this to go all the way down here. I would have expected it to go below 748 and to either hit the MVC or go below MVC. So for me, the real play would have been probably like a 1 or 2 candle play, but my runners might have been able to catch this move. All right, here we're looking at Meta on 7-9. I expanded a little bit of the chart because going bar by bar is probably going to be way too slow for going over these, but you get how I usually go through these. Now, what I'm looking here is this was actually a narrow range 4 Crable indicator. So we have this little Crable breakout box here, and we actually end up breaking out right here, and then you would have entered probably here and then just keeps going up. We do have a breakout also on the 15, 30, and the 1 hour range, opening range. It seems like we do have these big calls as we break out of this opening range. That is interesting. And as I look at the interaction between Momo and indicators, we have a pretty big Momo bar down here. What are the percentages on these? Not quite top 10%, but still somewhat big. Then we have not a huge Momo up, but big move up. Then we have big Momo down, but fast flow is like, nah, we're going up here. So we go up. Then we have the price kind of grinding up. As you can see, these are tiny Momos, but the price goes up quite a bit. And then here we have a bit of a bigger Momo, but price doesn't go down too much. Although here we do have somewhat small Momo and price goes down. That's interesting. So let's keep going. We do get a breakout. And then if I expand it all the way, we kind of have almost a stair-step pattern, right? We go up, we consolidate, we go kind of up and consolidate, and then we go up and consolidate, and then we go up once again. So kind of a bit of a beautiful stair-step pattern here. And then a couple more things to notice. As you can see here, this first bar, we get quite a, somewhat a big fast flow and Momo, and then price moves up quite a bit. But then we get a similar size fast flow and Momo here, but then this one doesn't really move that much. So there has to be some sort of ceiling around here. And in fact, these Lime and Momo combination actually end up being a little bit bearish until later here. But net options flow keeps climbing up throughout the day. Now, if you're asking me where I would have entered here, that really depends if I'm actually watching this stock, because if I saw it on Crable, I might be a little bit curious. NR4 by itself isn't always enough to pique my curiosity. But if I saw it in our 4 breakout, all of these breakouts right here, this call flow, I would have considered entering long actually probably right after this breakout, just to see if it kept going as a momentum play, because momentum is actually kind of used to be my bread and butter. I used to swing trade a lot more. So I'm comfortable taking trades like these at a smaller size to kind of see a continuation trend. And then realistically, I probably would have gotten out here out of most of my position after seeing this signal here with a little bit of bearishness, because I'd be thinking, this could actually be a potential reversal. So let me take some profit and leave a little bit of runners with a stop probably right around this area here, which never probably would have hit. Let me see, never would have hit. And then I would have just stayed on for the ride. Now this chart, I'm not going to hide from you because we've looked at it previously, but let's put all of these things together. Okay, so we have a Crable inside day. So we do have actually a Crable breakdown here for a potential entry to the downside, with a Crable breakdown downside, with the call wall moving down, Crable breakdown, NBC moving down, and then these Momo bars as well. We get a really big up Momo bar and then some small down Momo bars, leading to a really big move in price. So small down, big move in price. And then we get a somewhat sizable Momo bar up. It's, probably the combination of these, which if you look at it here, which one is that? Not only does it not move the price up, the price keeps coming down. So that's still bearish. Then I see Momo buying while this is going down, so there's some bearishness to it. And then on this candle, we get a bit of a spinning top. So I do see that Momo was selling and Fastwell was selling, but it was still weak enough to where this bar, kind of wicked down. It tested this breakdown and was like, nah, we're not gonna break down today. So while I might not necessarily take this trade here on this next candle, it really depends on the day and how confident I'm feeling that day and how close I'm watching the charts. For some people, this in itself and this price action is enough to take a quick little cheeky long with a mental stop around low of day or so, right? Pretty good RR. If it continues going down, you don't lose that much, but it could, of course, go up to this MVC, or eventually we see the call wall go up, MVC go up, call wall go up, call wall go up, MVC goes up. After, of course, after it comes down and price hits it and bounces off MVC. And then later in the day, we do start seeing, once again, MVC goes up. We have a cluster of these dark pools. And at the end of the day, we also have this kind of NOF reversal effect where it was going down all day. We get some put sold, which is bullish, but obviously not as bullish as calls bought. And we get this kind of effect right there. All right, we're basically to the end of this video, and at this point you know more about how markets actually work than probably 99% of retail traders. But now, of course, the trick is actually executing these, and BigShort and interpreting BigShort indicators is a skill, and learning a skill takes practice, right? Of course, this practice can be in the form of joining the BigShort tutoring channel, looking at breakdowns of how other people trade, looking at breakdowns of setups and trades on this YouTube channel, but you are going to have to actually paper trade and experiment yourself. And generally, I do recommend that you start off just looking at price action, looking at these indicators, and paper trading or really sizing down until you get comfortable with the indicators. Now, over the next couple of weeks, what I recommend you do is the following. Every day, check number one, check squeeze meter, check seasonality, and then open up your dashboard and the Toby Crable indicator for Zaratini and Crable if you trade non-SPY, and see if you find any tickers that are of interest to you. Check the dashboard as well. Scan the top 10 positive NOF, negative NOF, and the short exempt to find tickers that you might be interested in, and then just click on that ticker, open it up during the day, and see what things look like. Take a look at all the indicators. Obviously right now is pre-market, so you can't see that much. Take a look at the indicators. Take a look how the indicators interact with price. Take a look at GEX, Charm, MVC. You don't have to look at all of those. Generally, people find indicators that make sense to them, and then they work on those. So I recommend starting out by looking at most of them for at least a couple of days, and then narrowing down on both the setups and the indicators you want to focus on, and going deeper on those. And then throughout the day, if you do see a setup, either paper trade, mark it in your journal, or take a very small position, see how it plays out. And if there's no trade that you see, sometimes the best trade is no trade at all. And you can always ask us in the BigShort server, hey, I saw this on this stock, I saw this on SPY, I saw this on Amazon. Was this a setup you would have taken? Like, how would you have approached this potential setup and this combination of indicators? We're always happy to help. Second, entry timing, right? We already went over this. There's no hard and fast way about this. And you already know that depending on how fast the Ferris wheel moves and how many people go in and out of the Ferris wheel, it can take a couple of bars or a little bit longer or shorter for the indicators to actually play out. So a practical way of figuring out entries and exits when you're starting out is to, number one, just paper trade or trade a very, very small position and downsize. So if you usually trade, let's say 5 or 10 contracts, really downsize, only trade 1 or 2, like 10 or 20%. So if you see a signal, you put in about 10 or 20% of the position. Then if you see another confirmation, you put in another 10 and 20, and maybe that's it. Maybe you just keep 10 and 20 in, you ride that wave, you exit when you see the flow flipped or leave some runners, and then you rinse and repeat until you're comfortable trading in your regular size. I think the way Tay frames it is basically your entries and your sizing should be a function of your certainty, right? So as you're learning these indicators, you probably should not have a super high level of certainty just because you're still starting out. You got to figure it out. You got to experiment. So lower the risk by lowering the number of contracts or shares you trade. And then as you figure it out, you can go back to your normal size or even higher as you see BigShort work for you. And remember throughout all of it to use Discord. Ask dumb questions, ask smart questions, ask any questions. Feel free to ask me or Jeff or just the Discord in general. We are very tolerant of dumb questions, at least we are. Tay might not love them as much, but he does like really smart questions. So if you have a really smart question, Tay might be able to answer. And if you have questions that you would consider to be dumb, Jeff and I would be happy to answer those. Plus, if there are any setups that caught your fancy, take a look at those on the YouTube channel. They're going to be in this playlist and somewhere in the description below. And take a look at the example trades that we post on the YouTube channel and also inside of the Discord and BigShort tutoring. Of course, simply watching things and implementing them is going to be different. So number one, watch and learn. And number two, practice, whether that means going bar by bar, whether that means playing chart game, whether that means actually actively trading or paper trading or trading very small. Make sure that you both learn and you practice, because otherwise it's just not going to work. So at this point, you've got the platform, you've got the Discord, you've got our help. All you got to do is go out there, experiment, ask questions in the Discord. And now at this point, you've got a whole picture of how the market works, including flow, dealers, manipulation, a lot of that fun stuff. So go read the market, make some money, and I'll see you inside the Discord.